Hi everyone. Today I'm going to talk about what is the impact of interest rate movement on debt mutual funds. Uh, Unlike a equity mutual fund or as a equity asset class where investors are more aware because you tend to get the information much freely compared to debt space. We know that okay now biggest concern is November US election and what would be the impact of that, and we are mentally prepared that okay if market goes down I am mentally prepared okay because of this event uh, I am seeing a loss in my equity portfolio. But in the same way we can't talk about a debt mutual fund. We are not aware what's happening in the debt market, what are where is the interest rate cycle, what are the chances that interest rate will go up or go down. It's very cumbersome for a retail investor to understand these aspects. Let us look at what's happening in the G6 space, and I will take you through uh, what is the impact of interest rate movement on the debt mutual fund also. If you look at, suppose if you go ahead and invest in a 10-year G-Sec paper, yield is around 5.86. For a 5-year yield is around 5.18. And differential by going from a short duration to long duration, you can see that highest is 22.75% increase if you go for 5-year versus 2-year. But if you go for a 10-year versus 5-year, it's around 13%. 3 to 5-year is 10%, and 2 to 3-year is 10.66%. Let us look at what happens as a retail investor. You will go and invest in government bond for a 5-year period today. Suppose if you invest 100 rupee, assume that you are getting yield of 5.15% similar to bank FD. What happens after 1 year if interest rate goes up by 100 basis point plus? As example, let us take 6.5% is interest rate 1 year down the line in 2021. Then you feel that okay you are not getting optimum yield for your debt instrument. Then you decide okay I'm only getting 5.15. Let us do one thing, let me exit out of this debt paper, let me buy a higher yielding paper. Are you going to get 100 rupee back or more or less? Let us calculate. I have shown the value here, but how you calculate is you input in the financial calculator, you input 4 for a number of years, future value is 100, payment is 5.15, I by Y, what is the market interest rate, that is 6.5. You have to compute present value. Value will be 94.85. For 100 rupee investment today, 1 year down the line, you will get only 94.85 rupees if interest rate goes up by more than 100 basis point. From a 5.15, it goes up to 6.5. By investing in the government bond itself, you will make a loss of 5.15 rupees for every 100 rupee what you have invested. Let us look at in the similar way what happens in case of a debt mutual fund. I have taken these two debt mutual funds. You can see that average maturity is around 8.6, and the YTM is nothing but yield to maturity is 6.87, far higher than your bank FD. Bank FD is giving you 5.25, 5.5% for a 1 year, 2 year kind of a tenure, but you will make much higher tax efficient in case of a debt mutual fund. But what happens is we have to see if interest rate goes up, what would be the implication. Here comes something called as modified duration. Modified duration is nothing but sensitivity towards interest rate movement. It denotes for every unit of, when I say unit, every percentage increase or decrease in interest rate, what would be the change in underlying valuation. So here if I take a Kotak as an example, for 1% upward movement of interest rate, instead of 6.75 as an investor you would have pre-decided, you will end up making only 0.78. I'm not even calculating a fund expense here. fund expense in these kind of papers are upward of 1%. So technically you will not make any return if interest rate goes up by 100 to 150 basis point. If interest rate goes up by 2%, you can see that forget making a return, you will end up making 7.5 to 8.5% loss in these two funds. But still advise go ahead and suggest these funds, because expenses on a higher side that result in higher commission. Nobody is aware of where exactly is the interest rate cycle, and nobody is ready to look into that aspect. And as a product, it is easy to pitch. They will only talk about this YTM. They will not talk about modified duration and what would be the interest rate scenario another 2 year 3 year down the line. So be careful if somebody comes to you with these kind of higher average maturity papers. Understand the impact of interest rate movement on your underlying debt holdings. If you have surplus money which you want to invest for a 6 month, don't invest in other than a liquid and a liquid plus. If it is for more than 6 months, then you can consider low duration funds. Above 1 year, you can consider short term debt funds. Try to keep the average maturity of these debt instrument between 2 to 3 years. So like in our previous example, if interest rate goes up, it is easy without having too much of a negative effect in the underlying holding. Fund manager will be able to churn the portfolio to higher yielding papers. But if they have a instrument with a higher maturity, they will have a huge loss in their underlying holding. They will be able to reinvest at a much lower valuation. Hence, invest in paper with a maturity below 3 years. Try to safeguard your principal with that awareness. Thank you. Hope this video was very informative.